Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, October 30th, 2020. And our top stories today: how will millennials change investing? And Yale Endowment's manager pushes diversity. Well, joining me now to discuss this and more is Devin Banerjee. He's Senior Financial Services Editor for LinkedIn and also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, thanks so much for joining us on the program this morning.
Absolutely, Jeff. Happy to be here.
It's always great to talk to you. A lot going on, I'm sure, on the platform about finance and a lot more. What's top of mind this week?
Yeah, Jeff. Really popular story we featured this week based on a really interesting essay in The Economist, effectively in defense of this millennial investing generation. You and I have talked about this boom in millennial investing so much. And as you know, Jeff, a lot of the headlines are quite snarky, basically implying that millennials don't know what they're doing, are taking on too much risk, are using platforms like Robinhood and others without full knowledge of the risks that they're taking. And really what this Economist essay pointed out is that this is all about to change. So if you think about the boomer generation, those aged about 56 to 74 right now, I mean, it's clear they had a real outsized impact on the capital markets in America and how those capital markets developed. These boomers were in their prime earning years through solid economic growth, rising markets, rising asset prices, even on the fixed income side as interest rates steadily declined over their prime, earning and investing years. They had fat corporate pensions. Remember those DB plans, defined benefit plans. So on average, this boomer generation has about $600,000 in savings on average, each boomer. And the asset management industry has really been built around this mountain of money. And at first glance, this younger generation, the millennials, don't look like they have the same sway or influence over the asset management industry. Those under 35 on average right now have about $35,000 in financial assets. This millennial generation born 1981 to 1996, they own just 7% of all such financial assets in the US. That's a far cry from the 26% share that the now boomers had at that similar age. So 7% versus 26%. The younger generation, of course, has also been hit by two economic crises in just the past about 10 to 12 years. So they're less likely than their preceding generations to own a house or own a car. So all that stuff I just mentioned is just kind of facts and averages that we've established. The Economist essay really points out, as I said, that this is all about to change. If you think about this millennial generation, or just a young generation in general, they acquire wealth by earning it and by inheriting it, right? Those main two buckets. And if you think about this millennial generation, both of those buckets are about to accelerate for them. They're about to enter their prime earning years, and inheritance is set to accelerate. That's kind of the key piece of this Economist essay that a lot of people picked up on and realized is kind of absent from this conversation that we have about the millennial investing generation. So about every 5 years right now, Jeff, about $1.3 trillion in investable assets, it's about 5% of the total, passes between generations, from one generation to the next generation. That pace is expected to double in the 2030s, next decade, as this older boomer generation starts, unfortunately, passing away. And that is going to have, huge implications for just the volume of investable assets in control of millennials. Just one more point I'll get into, which is once this mountain of investable assets is in the hands of millennials, millennials probably won't invest in the same way as their parents did. They generally, even before inheriting, have a lot more control over their investments. You're the expert in this field, Jeff, as they have defined contribution plans or 401k plans, where they have control over how those assets are allocated and invested, unlike the defined benefit plans, the corporate pension plans of the past. And then number two I'll mention is technology. I mean, you and I talk about this all the time, technology has allowed an ease of investing that has really not been there in the past, and also an ease of scrutinizing potential investment options. And as we know, millennials and the younger generation are far more likely to make investing decisions based on criteria outside of just earnings potential and profits. They're looking at corporate governance and societal factors, environmental sustainability, all of those other values that they hold dear in their everyday lives. So again, this generation is not to be laughed at or not to be discounted. And we've seen some big players in the asset management space already recognize this and start pursuing M&A and start pursuing new business strategies to prepare for it.
Well, Devin, I'll just say that I think you paint people with a broad brushstroke at your own peril. So I would never paint a group of people in a certain way and say they're all this or that. I would say the one thing that I do get concerned about in general with people, and not just millennials or Gen Z or even Gen X or Boomer, is around financial education. What's your sense? You know, everyone talks about Robinhood. We've talked about it on the show that there's been an influx of trading. People are home. They're doing some more trading. They're doing some more short-term trading. Just in general, that doesn't seem to be a good thought process, regardless of if you're a young person, a mature person, in general. Any thoughts on that?
It's true. And that's a lot of the reaction we saw, Jeff, on the platform, is that this young generation is kind of plowing in, going in head first, into investing without understanding it fully. And look, and again, we're again painting a broad generation with a broad brush. And some of them are, properly conducting research and diligence and banding together to share research and share diligence, or there are even some startups that are helping them do that research and share and distribute that research. But yes, of course, a lot of people are mentioning, especially on this item that we featured, that it will take a couple market cycles, which we should be going through one right now, although the market has been quite resilient so far during this downturn. But it will take a couple cycles for millennials to learn. That said, the boomer generation, which, as I mentioned, benefited from some of those larger business and economic tailwinds, did amass quite a lot of wealth through means that were not directly tied to invest. They didn't have to work in investment management to have a solid defined benefit corporate pension plan, which probably performed well and has left them with a lot of money. So it's not to say that they necessarily learned more about investment management than millennials are learning right now.
Yeah, I agree with your sentiments there. And I think that experience is a great teacher, and being, certainly millennials having to go through 2 downturns in such a short period of time has an impact on earnings and certainly shapes how you think about markets. Well, Devin, I want to take a quick break. When we come back, we're going to talk to Devin about the Yale Endowment Chief really pushing diversity. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. We're talking to Devin Banerjee of LinkedIn. Devin, thanks so much for staying with us this morning.
Absolutely, Jeff. Happy to.
So let's talk about diversity. And this is a topic that we have talked about numerous times, both in your segment and elsewhere. It seems like the Yale endowment chief really has set a line in the sand that could really alter endowments and foundations and investment teams and organizations with whom they invest.
That's right, Jeff. It's an important part of this larger diversity conversation that you and I have been having, and this larger society has been having. And it's important because these are organizations that control the purse strings, right? These are organizations who have real sway and influence over the financial services sector and the investment management industry in particular. So we're talking about the Yale Endowment. It's the second largest in the country. It stands at about $31.2 billion. And it's actually been led since, I think, 1995 by David Swensen, a real pioneer in the endowment investing space. And I'll get into some of those reasons why he's been a pioneer in the past. But really what he has done now is issued this letter on October 2nd, which is actually posted on the Yale Endowment's website, to the roughly 70 investment managers in the US to which the Yale Endowment allocates capital. These are investment managers, so think private equity firms, real estate investment firms, venture capital firms, other money managers that, in large part or in some part rely on David Swensen's judgment and his team's judgment to receive that capital from the Yale Endowment. And so I want to just pull up a couple of things in this letter that he pointed out. Again, it was dated October 2nd. And really what David Swensen here is saying is that we've talked a lot about diversity in the investment management space. Everyone wants it, but genuine diversity, he says, remains elusive. And that gives investors like Yale and your firm, he's saying in this letter, an opportunity to drive change. He says success will be measured by hiring, training, mentoring, and retaining women and minorities for positions on the investment teams in your firm and at Yale, he says as well. His team, he recognizes, needs some improvement on the diversity front. Now, if you look through this letter, basically he is saying his team will ask on an annual basis, will distribute this survey to their managers, in which these managers will indicate the diversity of their teams and their investment teams across various levels of seniority. Now, David Swensen is not laying out specific targets that he's looking for here. Of course, there are many factors that go into determining whether the Yale Endowment will allocate capital to these managers, but it's basically a veiled message that diversity is going to take a larger role, and that factor is going to play a larger role in the endowment's investment decisions. Now, he even dispels a couple myths in this letter. He says he would like to emphasize the importance of entry-level positions. He has heard, as many of us have heard, firms complain that, look, there are just not enough, the pipeline is not full enough. There isn't a large enough pool of diverse candidates to recruit from. We hear this argument all the time. And Swensen says, look, solve this problem by recruiting directly from colleges. yeah, for example, he says, we don't solve this problem of underrepresentation by recruiting candidates from other investment organizations. That's a zero-sum game. It's not going to improve the diversity in the overall industry. So he says, rethink how you recruit junior analysts and then how you train them. So try directly from college campuses, as I said. Try training them directly instead of relying on the investment banks and the consulting firms to do that. He says he hears from a lot of these managers, these firms, that they have very specific cultures that they're very proud of. He says, well, why not take the opportunity to train your new hires directly in these cultures? Now, this is all really important, Jeff, as I said at the top, because David Swensen holds a lot of sway and influence in the endowment investing world, and relatedly in the foundation investment world, because they operate quite similarly. Yale was one of the earlier endowments to pursue an ethical investment policy, where it's laid out investment policies for things like climate change, assault weapon retailers and manufacturers, private prison operators. Swensen is also the pioneer of what's called the Yale model among endowments, which is which was an early pioneer in diversifying beyond just equity and fixed income managers, and pursuing alternative investments like private equity, real estate, and venture capital. So a lot of people are paying attention to this, and a lot of his peers, other endowment CIOs, some of whom actually trained under him at Yale, are taking notice.
So, Devin, I would imagine, number one, that there's probably some mixed reaction on the platform, but number two, this has an opportunity to really shake up. You mentioned other big investment bosses managing the foundations and endowments. This could really shake things up from some of those large endowments as well.
That's right. And the reaction is just on fire. And I don't mean that in a good way or a bad way, but both on a couple of the stories. The Wall Street Journal was actually the first to report this letter, and I was looking at their comment section on their story, which is, I think, up to about 600 comments, and our featured story, which also has hundreds of comments. Now, look, you're going to get this, what I would call the standard reactions on both ends of the spectrum. There are those who say, look, quotas, mandates, et cetera, just don't work. You need to take into account merit and track record when you're hiring, which of course I don't think David Swensen disagrees with, and of course I'm not trying to speak for him, but what he's saying is that diversity just is going to play a little bit more of a factor in their investment decisions. As I said in the text of the letter, which anyone can read online, he's not laying out those targets or mandates or quotas, but of course there is that gut reaction from a lot of people. Then there are a lot of people we've seen on our item on LinkedIn, younger professionals in the investment management space saying, thank God, I don't see a lot of people who look like me. I want to succeed in this industry. I have the smarts and the diligence, and I will build a track record. And if this helps me progress in my industry and supports representation of others like me, then I'm all for it. So again, kind of the quote unquote standard reactions you would see on both sides. But again, it's something that David Swensen has decided to do and put this out publicly, and many others in the endowment investment space and the chief investment officer space generally will pay attention to this.
Well, I think it helps to have the conversation. It helps to put it out there for discussion. If you're not discussing it, you can't move forward, or you can't come up with ideas. And I'm always really interested to see how big asset owners and pools of capital are handling these types of issues.
And actually, Jeff, I would just point out really quickly, it's related to a topic in the news today, this Thursday that we're recording this. Apollo Global Management, one of the largest private equity firms in the world, had its earnings this morning, and a lot of time was spent on the founder and CEO, Leon Black, who's kind of under fire for his past relationship with Jeffrey Epstein. And he's under fire for the reason what's really putting him under the spotlight are his LPs, these asset owners, these pools of capital. A pension fund in Pennsylvania, one in Connecticut, both have said they will pause allocations to Apollo while an investigation by a law firm that Apollo hired is underway. Several consultancies that advise state pension plans and other private equity LPs have said they will stop recommending Apollo funds while this investigation is underway. So LPs, these pools of capital, have a lot of sway over high-profile figures in the investment management space.
Yeah, and that's, I think in my mind, that's a good thing, and you need more diversity in terms of thought and points of view, and I think you're going to get that whether you ask for it or not. Devin, always a pleasure chatting with you. Great topics again this week. Have a great rest of the week and weekend, and we'll talk to you again very soon.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Don't forget to drop us a line. And for all the news in retirement markets, technology, personal finance, so much more, all in one place, check out our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow for BRN Weekly. We've got a very special guest, and then we'll take a look at some of our best segments for the week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.